All right, I'm here to give you an urgent briefing. I want you to forget everything you think you know about Chinese markets right now, because a huge structural shift, something that was set in motion in the very last days of 2025, is about to define global capital flows for 2026. This is your playbook.
So, what exactly are we talking about here? Look, this is not just another policy tweak from Beijing. No. This is the beginning of what we're calling the Great Repatriation. It's essentially a forced convergence of private capital and state ambition. And what that means for you is that it creates a very, very clear set of winners and losers. The time to get positioned for this is right now.
Okay, so let's dig into the core of this. At the heart of this entire shift is a hidden deadline. You see, a mandate was quietly pushed out on December 27th, 2025. And right now, the clock is ticking. And it's ticking fast, towards its full implementation.
And this timeline is absolutely crucial to understand. The mandate was issued right after Christmas, 2025, basically giving corporate treasuries just one single quarter to restructure everything. We're talking about a massive scramble. Then, boom, April 1st, 2026, the new rules become fully effective. Let me be clear, this is not a drill. It is a hard deadline.
Okay, now here's where it gets really interesting. It all comes down to the legal language. The mandate states that proceeds must be repatriated in principle, or yuanzishang in Mandarin. Now, for those of us in the West, in principle sounds kind of soft, right? Like a suggestion. But in Chinese administrative law, it is anything but. It's a default command. It completely flips the script. It used to be you could keep cash offshore unless told not to. Now, you must bring it home, unless you go and get explicit permission before you do anything else. So let's break down the core rules here. First, all proceeds from overseas IPOs, they have to come back to China. Period. Second, if you want to use funds offshore for anything, an investment, an acquisition, you need pre-approval. That gives Beijing a total veto. Third, dividends from mainland owners of Hong Kong-listed stocks, what we call H-shares, are now locked onshore. They have to be settled in RMB. What these rules do effectively is create a giant capital dam. They ensure that any money raised on the promise of Chinese growth is actually invested back into China. Now, this is so important to grasp. This repatriation mandate isn't happening in a vacuum, not at all. It's actually designed to supply the fuel, the capital, for a massive fiscal pivot that's happening at the exact same time. What we're witnessing right now is a truly historic divergence in policy. On one hand, you have the US, which is entering a period of fiscal austerity. All the talk is about reducing deficits. But on the other hand, China is opening the fiscal fire hose. They are deploying a much more proactive policy to fire up domestic demand and, crucially, to fund or push for technological sovereignty. This clash of policies is already triggering a major global rotation of capital away from the US. And just look at the scale of this spending. It's immense. We're talking about a target of 3 trillion RMB in what they're calling ultra-long special sovereign bonds. Let's be clear, this is not your standard short-term stimulus package. No, these are 30, even 50-year bonds. They're designed to fund the technological and industrial build-out for an entire generation. Think everything from semiconductors to robotics. So this is how it all connects. It creates this brilliant closed-loop system. Let's walk through it. Step 1, a company, say the battery giant CATL, goes and raises billions of US dollars in a Hong Kong IPO. Step 2, the new repatriation rules force them to convert all those dollars into onshore RMB. Step 3, the Chinese banks, now flush with all this new RMB liquidity, use it to buy those ultra-long government bonds we just talked about. And finally, step 4, the state spends that money on subsidies and R&D for its strategic priorities, which, you guessed it, often benefits the very same company, like CATL, that raised the capital in the first place. It's a genius move, really. Foreign equity capital is being directly recycled to fund Chinese state industrial policy.
Okay, so this brings us to the core of the strategy. The real question is, how do you position for this massive shift? My advice? Forget broad market exposure. That's not the play here. We need to be surgical. We need to focus on what I call the state team. These are the companies that have been explicitly chosen to win in this new regime.
First up on the state team, BYD. They are the undisputed leader in electric vehicles. Not just in China, but increasingly on the global stage. And they are a prime beneficiary of this new fiscal stimulus. Why? Well, things like the expanded vehicle trade-in programs are designed to do one thing, directly boost BYD's sales and cement their market dominance. And the numbers here really back this up. If you look at the data from late 2025, even with all the market volatility, the analyst consensus was pointing to significant upside.
And the reason for that is simple. It's not just about fundamentals anymore. Fiscal policy is now directly subsidizing BYD's top line, creating this incredibly powerful government-backed tailwind. All right, next up on the team is SMIC, China's national semiconductor champion. And in the context of the global tech war, you have to understand, this company is way more than just a business. It's a national strategic asset. It is the primary vehicle for achieving chip self-reliance, and that makes it the absolute focal point of state funding in this critical sector.
And look, the market has already figured this out. SMIC was identified as a key winner almost immediately. Its stock surged on heavy volume the very moment that Fiscal pivot was announced in late December. This is a clear signal. The smart money is already moving in.
And this right here, this is the crucial link you need to see. The state isn't just throwing minor subsidies at SMIC. No, it is using the proceeds from those 3 trillion RMB in sovereign bonds to underwrite its entire capital expenditure cycle. I mean, think about that. It is essentially a blank check to achieve technological sovereignty at any cost. Okay, finally, let's talk about CATL, the global battery giant. Its mega IPO in Hong Kong was so much more than just another listing. You have to see it as the real-world template, the test case for this entire new era. It shows us exactly how this system is designed to work in practice. So, CATL raised $5.3 billion, making it the world's largest IPO of 2025. A huge number. But the number itself isn't the most important part. What's more important is that this IPO was the first major stress test of the new repatriation mandate. Every single dollar of that capital is now subject to these new rules, and that makes CATL the blueprint for every single offshore listing that comes after it.
And this is where it gets really clever. What's so strategically astute is how CATL is navigating the geopolitical minefield. Remember, they're on a U.S. entity list, so how do they get around that? Well, instead of investing directly in the U.S., which would be blocked, they bypass sanctions by licensing their technology to partners like Ford. This creates a whole new model, a new blueprint. You keep your capital onshore to stay compliant with Beijing, but you export your intellectual property to collect royalties from Western markets. It's a brilliant workaround. But, and this is a big but, every strategic pivot like this also creates losers. For any assets that are left outside of this new closed-loop system, the situation is becoming, frankly, perilous. So this is the warning. What this policy does is create a stark bifurcation in the market, a great divide. On one side, you've got the state team, those industrial champions being flooded with fiscal stimulus. And on the other side, you have the legacy internet platforms. Think about the big tech names. Their cash is now effectively stuck offshore. They are well and truly caught in a capital trap. So for these offshore firms, IMO, the risks are just mounting. 1, they're misaligned with Beijing's new focus on the real economy. 2, they're extremely vulnerable to being added to U.S. entity lists. 3, and this is critical, they now face huge regulatory hurdles just trying to use their own offshore cash for things like share buybacks. They simply don't have the fiscal safety net that the state team enjoys, and they are caught squarely in the geopolitical crossfire.
So let's wrap this up. The Great Repatriation is, without a doubt, the single defining theme for 2026. The policy vectors are crystal clear, the winners have already been chosen, and the losers are being left behind. The capital doors are closing, and they're closing fast. The only question left is, which side will you be on?